which is active versus index versus factor equity strategy for the 2020s. This has the potential to be a real punch-up. It should be really good, because we've got somebody from active, somebody from index, and somebody from factor, and then discussing what approach has the highest likelihood of success over the next 3, 5, and 10 years. So our moderator for this session is Ben Johnson, CFA, who's Director of Global ETF Research at Morningstar. Joining on the panel will be Chris Brightman, Chief Investment Officer at Research Affiliates, Steve Deshane, Research and Development Director of Capital Group, and Rick Ferry, CFA, Investment Analyst and Advisor at Rick Ferry, LLC. So please welcome Ben and his panel to the stage.
Using index funds exclusively, and I think it underscores an important part of this discussion, which is that I think sometimes the premise is just false. There's active and there's passive. It's not that black and white. So, how much of it, from your perspective, is truly passive? Can you call yourself truly passive? And to what extent are you doing so more so out of a desire just to minimize investment costs versus having any fundamental view on, the utility or futility of active security selection?
So a lot to your question. On the question of cost, I agree that active managers before cost have shown to outperform. It's not a question of skill. It's not a question of whether they're actually able to do it. The statistics and the studies show that active managers before costs are able to. The question is, the costs are how you do it. So the costs override the alpha that they create unless you have a negative return relative to basically beta. Beta is free now. Anybody can buy beta for free. So I want to take you to a different level. We're talking about a portfolio of funds for an investor as opposed to one fund. So you talked about large cap investment, and that is one segment of the market. And you might be able to screen in some way somehow for active managers that do have skill, that are not charging more than what they're getting in alpha. You may be able to do that in that one sector, you may not. But it's a portfolio that we're looking at. So if I just do all passive across the board, U.S. equities, national equities, treasury bonds, corporate bonds, just do all passive across the board. There might be one category or two, if I did all active, that might outperform, but it's not enough to make up what I'm doing with the all passive portfolio. The all passive portfolio will outperform the all active portfolio because most of my choices on the active side are going to underperform. Some will outperform, but most will underperform. This study that looked at the probability of the entire portfolio of passive outperforming a portfolio of all active. And the more passive funds you put in your portfolio, the higher chance that the probability of the passive portfolio will outperform the active portfolio. So it's not just one fund. A lot of times the debate goes down to this category or that category. But we're looking at a portfolio, and if you're using all passive across the board, we have a higher probability of outperforming the portfolio.
So Chris, you're very sort of happily sitting between Rick and Steve at the extremes here, representing kind of the middle ground as both an allocator and representative of one of the pioneering firms in the so-called smart beta space. So I'm curious to get your take as to how sort of quote-unquote smart beta approach, which I mean for all intents and purposes as being a new form of active management, tries to solve for simultaneously the deficiencies as you see them of both maybe a cap-weighted approach to achieving market beta as well as more traditional approaches to security selection.
Smart beta is a fun, provocative term. Some people find it annoying. We find it amusing. But what it means is important. It's taking well-known sources of excess return and delivering those in a strategy that is more transparent, simpler, and lower cost than traditional active management. And we've talked about the cost, and I agree. The problem with active management is not that there isn't the ability to generate excess returns over time. It's that the fees have been too high. Sometimes people would ask you, Chris, what's wrong with the active managers? They're doing so well. No, they're doing fine. It's the clients that are doing important. But I want to move beyond fees. I think we've beaten that to death, and talk about simplicity and transparency, because there's a huge slippage, and you know this very well, between the returns that are actually received by the end investors, which are measured by dollar-weighted returns. And that has to, an important component of that is the ability to stick with the strategy. If we have performance chasing, I think Cliff Asmus has referred to individual investors as using a momentum strategy over the time horizon where mean reversion exists. So if every 3 years you're dumping your underperforming managers and rotating into the managers that have outperformed over that 3-year period, and we write this article over and over again, you're doing huge damage to your portfolio. So there's hundreds of basis points of money being lost in client portfolios because of performance chasing, because they don't understand what's going on. It sounded good, we screamed it looked good, the fees seemed reasonable, the guy came in and told a good story, or my advisor told me a good story about the manager, and then they duly underperformed for 3 or 5 years, and that row on the report just got really annoying, and we don't want to talk about it anymore, and my gosh, can't we just dump that thing, find a replacement and move on? And that destroys an enormous amount of wealth in the portfolios. And we hope that by having greatly increased transparency and simplicity so that people know exactly what's going on in the investment strategy, it gives people the ability to stick with the strategy over the long run and actually realize those excess returns that are available and actually deliver them to the end client.
So there are a number of threads I think we've revealed here that I'd like to pull on a little bit more, but for the time being, I'd like to stick with the behavioral one in particular. And we were hearing at lunch today about, having any hope of improving kind of patterns of behavior requires regular feedback loops. But if anything, I think in investing that's proven to be potentially counterproductive. So Steve, when you think about not just being able to deliver alpha through security selection, but having your clients actually be there to experience that alpha at the time in which it's delivered, because any strategy is going to have its own cycles of out or underperformance, be it active, be it strictly calculated, be it somewhere in between. How do you think about solving for that at sort of the client level, which might be sort of multiples more important than kind of parsing what excess returns from active, passive, or smart beta might be at the portfolio?
Sure. No, it's a critical issue. When we think about it, that gap between investment returns and investor returns is one of the most important gaps to close. And we do it by trying to align with our investors and with our distribution channels around a long-term orientation. Everything that we do is about taking about a 5 and 10-year view. We pay people on a full market cycle. 5 and 8 years is the majority of their compensation. And our tenure, so that the ownership in the funds that we manage tends to reflect that. They're held literally twice as long as industry averages. So we think that's critical in helping to close that gap. And obviously we're able to achieve that because we largely, work with, folks out there who are providing investment advice. One of the things that's interesting when you look at the whole active passive debate is most of it is done on an equal weighted basis, treating every investment manager as a separate data point. And when you look at it on a dollar weighted basis, which actually looks at all of your work in selecting and screening for managers, the results get a lot better. So it's not that we have no information. We're not randomly picking active managers. We're actually working with all of you to do a much better job on the screening and the criteria, because obviously there's no guarantees in this world, but you can improve your probability of success to get well above the threshold that matters. We've already talked about fees, but we look at manager ownership, private versus public, long-term orientation, the compensation of the manager. You can get to a cohort of active management that is not only more likely to beat the index, but much more likely. So there's an opportunity to align on all those dimensions, and maybe the most important of all is time.
And I would say, shameless plug here from Morningstar Research, my team produces a piece called the Active Passive Barometer. To your point, Steve, we look at asset and equal weighted returns across different cohorts. And we see that, generally speaking, investors pick good funds, whether or not, on average, successfully kind of, running the rail, all good active funds across an entire portfolio, are there any areas where you're more flexible than others when you think about active managers' ability to add value versus their index?
No.
Thank you, Rand.
I'd like to comment on Chris's point about hanging there for long.
Yeah.
I have this saying that if you're going to do factor investing, you have to marry it for the rest of your life, because you can't just rent it. But what happens is you might fall in love with a strategy, and that happens year one. Sounds great, love the idea. Year two, not so much in love with it, didn't do well. Year three, you hate it. Year four, you fall in love with something else, and so you got to divorce this strategy. Well, that's the worst thing you can do. Once you decide you're going to do factors, whether it's quality or momentum or multi-factor, whatever it is you're going to do, you just can't be changing. It has to be, I believe in value, I believe in momentum, I believe in quality, I'm going to do multi-factor, one fund, what percentage of your portfolio is going to be factor. And you got to stick with it lifelong. And I say that, I had this discussion with Wes Gray from Alpha Marketing. And he said, you got to stick with it at least 20 years. I said, you got to stick with it for your whole life. And we compromised on 25 years. So can you imagine a retail investor sticking with a strategy, the same funds, the same asset allocation, the same factors for 25 years? The answer is they don't.
They'd be much better off.
They would be,
Yeah.
absolutely, no doubt, but they don't. So if you defaulted to just all straight total stock, total international, total corporate bond, total trade fund, that's all they get. They will, it's a higher probability. They're going to stick with that for the long term. Those are buy, hold, never trade funds. You don't have to worry about underperforming anything. You're not being sold a strategy that's supposed to outperform. Because the higher probability the behavioral thing isn't going to hurt them. And it just pushes them up.
So, kind of marrying your earlier comments, Chris, with Rick, so you described kind of a 3-year itch of sorts. If anything, in context of the marriage, 7 years is probably a better time frame if you're going to translate that to investors. But in that to manifest itself, I mean, if you think about the fundamental index in particular, and I've heard anecdotes from you and your colleagues about investors coming at the very bottom of the markets in 2009, just when that particular strategy was spring-loaded, deciding to hit the ejector switch when it did exactly what it was designed to do. So how do you instill that confidence in investors to love that strategy for better or for worse till death, or at least 25 years apart?
Our strategies have a distinct value orientation. I believe value investing is the right way to invest. I believe that comparing price to future cash flows has to be a part of any sensible investment program. And in the late 1990s, I worked with a firm called Prince & Parker, and later became UBS. And I would be meeting after meeting, and people would say, you guys are just lost it, or you're stupid, or what don't you get about Cisco? And saying the price just wasn't convincing to them. We're having a bit of a difficult period now, though the impact on our AUM and our revenues is remarkably modest, and it's coming into my wife, and it's very difficult. I feel like I've seen this before. She said, well, you would think you would want it. And the way that people are able to stick with it is because it is so transparent and simple. And back then, when I had a bunch of really hardworking, smart analysts trying to judge subjectively whether a stock was cheap or rich, it's hard to get confidence that we just didn't lose it, that we lost our edge starting in 1996. By 1999, you just don't understand it. You guys are old-fashioned. But when you describe what goes on in the fundamental index, this is a mechanical process. It's about rebalancing, selling all the stocks that have outperformed and rebalancing them down and buying all the stocks that have. Do you believe that over the long run that that's going to work? That's what you bought. That's what you decided upon. If you really believe that, you should stick with it. And so we've had very modest a number of people throwing the towel, despite a similar, value headwind to the late 1980s. And I attribute that to the transparency and the simplicity of the strategy.
So I want to move to the forward-looking statements portion of our conversation and talk about what the future holds for both active and indexed approaches to portfolio construction. So, Steve, we talked about costs being important. For active to survive and thrive going forward, what is that path forward? Do fees need to be reconsidered wholesale? Do different fee structures, performance fees need to be taken into consideration? And one thing we haven't really touched on is just, kind of the evolution of the advice landscape and how investment products are distributed.
Sure.
Which I think is an underappreciated element of the ETF wrapper in particular, given that it's kind of the Amazon Kindle to your local bookseller. Anybody can pull down whatever book they'd like, on demand as long as they're plugged into an exchange. So, what is the go-forward path for active as it pertains to costs and also as it pertains to sort of process and implementation? Is it more technology, more focused portfolios? What do you see in your crystal ball?
Yeah, no, and I think part of it is, earlier is the impact of fees and that kind of, being able to get out of the gravitational, force field of your own fees. And I do think that comes down to scale. And there will be scale advantages brought to bear in this process. And management companies that are committed to returning the benefits of scale to their shareholders and consistently lowering their fees will accrue the benefit of their lowering their own hurdle, and then they also have the scale advantages to invest in technology and new investments and more portfolio managers and on-the-ground research to improve their ability to produce, predictable alpha. When I looked at the difference between even 25 or 30 basis points, in costs, that's the difference between success and failure in many asset classes. And then if I put it on a consumer hat for a second, and I look at the difference of 150 to 200 basis points, which is what we've done in excess return over 85 years, that's massive difference in outcomes, which is what people care about. And I did one back of the envelope example of if you were smart enough to give Jack Bogle $10,000 on the first day he invested in an index fund, it would be worth $800,000 today. Broadly diversified S&P 500 index fund. And, that's a terrific result. And over the exact same 40 years, we've had 5 funds available, and you have had between $1.2 and $2.4 million in any of our funds. So there's an opportunity to use those scale advantages because people are interested in good outcomes. They're interested in achieving their objectives, and they do understand that there's an opportunity to do better. So I think there will be a change in the marketplace. There was an article recently about one of our competitors, and they were struggling in some ways, and they were laying some people off. And clearly to me, the issue wasn't quality, it wasn't, did they have bad strategy? They were charging 150 basis points. It's really hard to get out of your own way at 150 basis points and deliver value above that.
What about from the distribution point of view, the evolution of the manner in which funds are distributed? What are the challenges you see there? What are the potential opportunities for active managers to, at least maybe stem the tide by reconsidering how funds are distributed?
Yeah, I think you've got to add more value. You think about, we're not competing with robos in any way. None of you are competing with robos, I don't believe. It's incorporating technology into your process and into your delivery. And in the same way, asset managers need to think about other things they can do to add value to help you be more successful. One of the things that we've done recently is invested in portfolio construction and model development capability, making it easier for us to provide to you well thought out either glide path oriented portfolios or static portfolios to achieve certain objectives, whether it's college target date, retirement target date, or some specific, portfolio objective that you may have. And I think asset managers that have the scale and capabilities are going to get into the adjacent areas to be better partners. And we'll figure out the right way to develop approaches to be more important in your practice model to help you grow your business.
So, Chris, what's the next frontier as you see it within so-called smart beta? I mean, we've gone from fundamental weighting, there's been a proliferation of single-factor funds that have been brought to market, multi-factor funds come subsequently, multi-factor funds that try to time their factor exposures. Again, in my mind, for all intents and purposes, a form of active management. So how does that form of active management continue to evolve to be competitive versus more traditional forms as well as just on market outputs?
Two thoughts come to mind. First, the concepts of smart beta, applying well-known sources of excess return in simpler, more transparent products at very low fees can be applied beyond equities. It can be applied to the total portfolio. And I think that is a huge opportunity. And then second, I think we are going to see the continuation of efficiency in the industry lowering fees. And that's going to be manifested by an increasing amount of specialization. Quick story, when I started, the first job I had in the investment management business was at the First Chicago Investment Advisors in 1982, and we did everything soup to nuts. We had the client relationships, we had the researchers, we had the portfolio managers, the trading desk, the custody, the cage. How many of you remember the cage? I know, we charged 150 basis points for a plain vanilla U.S. equity portfolio. Today, one of our quantitative active equity strategies is probably 25 basis points, and we create the model portfolios. We hire a firm in Germany called Solactive to calculate the index. The trading is done by a firm in Seattle called Parametric. Distribution and administration is provided by PIMCO, and the back office and custody is handled by State Street. And everybody's making money per 25 basis point a strategy, and it's a good business. And it doesn't stop at 25. It's going to be 20 and then 15 and then 10 for what, as you described, what is essentially a very active investment strategy. And this needs to be applied for the total portfolio, which means that most of the people in this room can do what they're much better at, which is client relationships and helping people figure out how to save more and intergenerational transfers. And there's a huge amount of advice that can be provided that isn't trying to create hundreds of thousands of individual tactical asset allocators out there.
So Rick, before we open it up to the audience for a few questions ahead of wrapping, I wanted to give you a last crack at the forward-looking statements round and change the direction a little bit and ask the question, which I think is on the minds of many, is can the growth of indexing go too far? We're at a point where, at least as measured as a percentage of the U.S. funds market, which is a smaller denominator, we're at about 50-50 within equities between indexed and active. What, if any, concerns do you have about the continued growth of indexing and what that might mean for its efficacy going forward?
Not in my lifetime. There's such tremendous bandwidth to continue for the money to flow this direction. Okay. And it will continue to flow. So the bandwidth, I can't even see an end to the amount of money that could just go into total marketplace. I mean, sure, I guess it's some percentage, and nobody knows what it is, but I've been hearing the same thing now for 25 years. oh, you know, now that there's so much indexing going on, it just gives great opportunity to active management. 5 years later, well, now that there's even more indexing, there's even more opportunity for active management. Well, I've been hearing that 25 years. Haven't seen it, but I've heard it. So it's not going to stop. It's going to continue. I will say two things that would help the active side, active specifically. We are going to start to see an onslaught of actively managed ETFs, which are badly needed. And they're badly needed because mutual funds are very tax inefficient. And a lot of clients have money in taxable accounts. And they get these big, ugly tax distributions from actively managed open-end mutual funds every year. And they complain about it profusely. The ETF structure will solve that. So it'll make active management more palatable in a taxable account. And that needs to happen. So I think we're going to see that now with the new program that's coming out over the next year. Something Chris brought up about packaging things together. I think we're going to see more balanced ETFs where the portfolio is right there. I would love to be able to just say to a client who's got a $50,000 Roth or whatever, hey, just put the money in this balanced ETF. Now, right now there's only like 3 or 4 of them put out by iShares. Where are the rest of them? Where are they? Just take this kid's college account, plug it into this balanced ETF, you're done. We haven't seen that yet. So by packaging these things together in a portfolio, I think would really help. So that could help stem some of the flow down to straight passive. But so I think that those are the 2 things that I have.
Well, thank you. I want to open it up with the handful of minutes we've got left to the audience for questions, and we've got one here right up front.
Just real quick, I mean, you talked about the distribution. One huge advantage to versus mutual funds is the embedded distribution within a mutual fund itself. Right? So I would agree that being able to wrap active in an ETF and scrap out, not just only one sub-TAs that offer around 40, 50, 60 basis points or more cost. So I think that might be a thing that's been the magnitude of underperformance. I'm curious what your thoughts are about having more of that equal standing in terms of stripping out the distribution fees, having a clean share class.
Yeah, from an asset management perspective, I'm all for transparency. And we have an institutional share pricing, and we show those, R6 or F2 or F3, really that have stripped out the share classes. But I'd love to compete on a level playing field just for the value that we add as investment managers. I mean, mutual funds have become the paymaster for the industry. We're paying for platform development, we're paying for distribution, we're paying for advice, and people look at the fees and say, well, there's all those fees. Now, we do have to solve the distribution angle issue, which is obviously those platforms, those technology platforms and distribution platforms need to be paid for. So if mutual funds aren't going to be part of the paymaster in doing that, they're going to have to charge differently to their customers. And that's going to be an interesting transition. If everything was level playing field and you were just paying for investment management, what would you have to pay for those other services that get provided today by those sub-TA fees and 12b1 fees? So I'm all for it. I would love to be evaluated just on our investment management because it would make our results, which are already obviously terrific, look even better on a relative standing.
I think we have time for one more question. We have another question from the audience. Got one.
Yes. I talk about it. So I have a question in regards to the beta space, ETF space, in terms of drawdown risk. Obviously, there's a lot of uncertainties in the marketplace right now, and ETFs are growing, obviously in popularity, as you guys have talked about. We saw this huge drawdown risk, particularly in some of the risk assets, asset classes such as preferred. PFF, one of the largest preferred ETFs in the marketplace, iShares, had $3 to $4 billion of outflows in the fourth quarter of last year, which caused a huge drawdown in the marketplace, which was not necessarily representative of the fundamentals in the marketplace. Can you just talk a little bit about how that risk could grow potentially over the long term as ETFs become more popular?
I think that the risk that you're talking about is a risk, and it does bear some consideration. But I think the problem is worse in the open-end mutual fund than it ETFs have the ability to trade the entire portfolio or the underlying individual securities. Look at what goes on in the mutual fund space. We've trained clients to think that they've got next day ability to get out, and there are funds, forget about preferreds, there are funds of bank loans that promise, maybe they don't promise in the fine print, but imply that you have the ability to get out of that mutual fund with 2-day settle or 3-day settle. So that's a real issue, but I'm just saying pinning it on ETFs I think is incorrect.
Well, with that, we've got a flashing red light on us, which I think means they're going to unleash a driving. I want to thank everybody for your time.